Gold just did something that left investors confused, nervous, and honestly, a little scared. In just a short time, the price dropped more than 21% from its all-time high of $5,596, falling near $4,400 per ounce by the end of March 2026. Now, if you ask most people what caused this, they'll give you a simple answer. They'll say a strong dollar, high interest rates, normal correction. And yes, those things are true. But here's the problem. That explanation is only half the story, because behind the scenes, something much bigger is happening, something that Wall Street quietly understood, but never clearly explained to everyday investors. And once you see it, you won't look at gold the same way again. Let me ask you something. What if this drop isn't a sign of weakness, but actually the setup for the biggest move in gold history? Sounds crazy, right? But stay with me, because the real story starts with something most people completely missed. The $8 billion shock nobody explained. In just 2 weeks, one country made a move that sent shockwaves through the gold market. Turkey sold 60 tons of gold. That's over $8 billion worth. Now, at first glance, this might seem like a normal financial decision. Maybe they just wanted to rebalance their reserves. But that's not what happened. This was not a choice. This was pressure. This was panic. This was what you could call a financial margin call at the level of a country. What does a margin call mean for a country? Let's simplify this. Imagine you borrowed money to invest and suddenly the market turns against you. Your broker calls and says, sell something right now, or we'll do it for you. That's a margin call. Now imagine that happening not to a person, but to an entire country. That's exactly what happened to Turkey. The hidden trigger, the Iran war. Everything changed on February 28th when the Iran war began. Oil prices didn't just rise. They exploded from around $75 to over $100 per barrel almost instantly. And here's why that matters. Turkey depends heavily on energy imports, about 90% of its oil, around 98% of its natural gas, and all of that is paid in US dollars, not their local currency, the $20 billion problem. Because of the oil spike, Turkey's energy bill didn't slowly increase. It jumped by about $20 billion per year immediately. That created a huge problem because suddenly Turkey needed a lot more dollars and very fast. The currency collapsed. At the same time, Turkey's currency, the lira, started crashing. It hit new record lows again and again. In fact, it dropped to fresh lows 11 times in just 16 trading days. Think about that. That's not normal volatility. That's a currency in free fall. 3 impossible choices. Now, Turkey's central bank had to act fast, but they only had 3 options, and all of them were painful. Option 1, let the currency collapse. Yeah, that would cause runaway inflation and political chaos. Option 2, use dollar reserves, but those reserves were already low. Option 3, sell gold, and that's exactly what they did. Why gold became the target. Gold is one of the few assets that can be quickly converted into dollars. So Turkey started selling fast, massively, not because they wanted to, but because they had to. And here's the key idea you need to understand. This was not strategic selling. This was forced liquidation. And that changes everything. Why this matters more than you think, because Turkey is not alone. And this is where things start to get really interesting. Other countries are facing similar pressure. And if they follow the same path, then what we're seeing right now is not just a dip. It's the beginning of something much bigger. The question you should be asking, if the countries that pushed gold to record highs are now being forced to sell, then what happens next? Does gold keep falling, or is this setting up something even bigger? Now, here's where the story takes a turn most people never see coming, because what happened with Turkey, it's not an isolated event. It's part of a much larger global shift that is quietly unfolding right now. And once you see the full picture, it becomes impossible to ignore. The pattern begins to emerge. Let's zoom out for a second. Over the past few years, central banks around the world have been doing one thing consistently, buying gold aggressively. They were the driving force behind gold's massive rally from around $1,800 to nearly $500-600. Countries like China, India, Russia, Poland, Turkey, they weren't just buying, they were stacking gold at record levels. And that wasn't random. It was strategic. Why were central banks buying gold? because something changed in 2022. When the US and its allies froze Russia's foreign reserves, it sent a message to the entire world, a very clear one. Your reserves are not really yours if they can be frozen. That moment changed how countries think about money, because suddenly dollars had risk, bonds had risk, foreign reserves had risk, but gold had no counterparty risk. No one can freeze it, no one can print it, no one can block access to it. Gold became financial freedom. That's why central banks rushed into gold. It wasn't just about profit, it was about protection. Protection from sanctions, currency devaluation, political pressure. Gold became the ultimate backup plan. But now, something strange is happening. The buyers are turning into sellers. Let's look at what's happening right now. Turkey already sold 60 tons. Russia, selling gold to fund war expenses. India turned into a net seller in early 2026. China paused its buying. Poland, considering selling 550 tons. Read that again. These are the same countries that fueled the bull run, and now they are stepping back or even selling. So, is the bull market over? That's the question most investors are asking. And honestly, it's a fair one, because if the biggest buyers are gone, then who's left? But here's where most people get it wrong. They assume this shift is a change in strategy, but it's not. It's something very different. Strategic selling versus forced selling. This is the most important distinction in the entire story. There are two types of selling. One, strategic selling. This happens when a country no longer believes in gold. They want to move into other assets. It's a long-term decision. Two, forced selling. This happens when a country needs cash immediately. They are under pressure. They have no other choice. What we are seeing right now, forced selling, not strategic selling, and that changes everything, connecting the dots. Let's go back to each country. Turkey, selling gold to defend its collapsing currency. Russia, selling gold to fund war expenses. India, selling due to currency pressure and liquidity needs. Poland, considering selling for defense spending. China, not selling, just pausing. Do you see the pattern? None of these countries are saying gold is a bad investment. Instead, they are saying we need cash right now. This has happened before. And this is where things get really interesting, because this exact pattern has repeated itself multiple times in history. Major gold cycles have always included moments like this, moments where prices fall, fear spreads, selling increases. But underneath all of that, the long-term trend stays intact, the forgotten cycles. There have been several major resets in gold over the past decades: 1976, 1983, 2008, 2013. Each one followed the same pattern, and almost nobody recognized it while it was happening. The cycle. Nobody explains. Here's how it works. Step one, crisis hits. War, financial shock, or economic stress. Step two, forced selling begins. Countries sell gold to survive. Step three, prices drop. The market reacts with fear. Step four, retail investors panic. People assume the bull market is over. Step five, selling accelerates, more pressure, more fear, and then something changes, the turning point. Eventually, the crisis stabilizes, the forced selling slows down, the panic fades, and then the buyers come back. Why they always come back? Because their reason for owning gold never changed. They didn't sell because they stopped believing in gold. They sold because they had no choice. And once the pressure is gone, they return, stronger than before. This is the reset. This is what we're seeing right now, not the end of the bull market, but a reset inside it, a clearing of excess, a moment of pressure before the next move. And this reset is different, because today's world is very different from the past. Think about it. Global debt is at record highs. Geopolitical tensions are rising. The dollar system is being questioned. Countries are looking for independence, and gold sits right at the center of all of it. The big question. So now the real question becomes, if this is just another reset, then how big is the next move? Because history suggests something powerful. The bigger the reset, the bigger the move that follows. Think about this. If central banks return, if demand comes back, if supply tightens, then what happens to the price? How big this moment could become? That's where things start to get serious. This is not a normal cycle. At first glance, this looks like just another gold correction. We've seen drops before, we've seen panic before, we've seen forced selling before, but here's the truth. This time is fundamentally different, and the reason comes down to one word: scale, the debt explosion. Let's go back in time for a second. In 1973, when gold began one of its biggest bull runs in history, the total U.S. national debt was about $500 billion. Now fast forward to today. That number is 39 trillion. Let that sink in. That's not just bigger. That's an entirely different reality. Why debt changes everything? Because debt creates pressure. Pressure on governments, currencies, financial systems. And when that pressure builds, something has to absorb it. Historically, gold has always been that absorber. Gold is not just an asset anymore. This is where most people misunderstand gold. They think it's just a commodity, a hedge, a safe haven. But in today's world, gold is becoming something much bigger. It's becoming a financial anchor, a backup system when trust in traditional systems starts to crack. A fragmenting world. Now add another layer to this story. The global system is changing. We are seeing more geopolitical tension, more trade conflicts. More economic fragmentation. Countries are no longer fully trusting each other, and that matters because trust is what holds the financial system together. The 2022 wake-up call. Remember when Russia's reserves were frozen? That moment changed everything because it showed the world, your money isn't truly safe if someone else controls it. And that fear didn't disappear. It spread. Gold became strategic. That's why central banks didn't just buy gold casually. They bought it aggressively because gold gives them something no other asset can: control, no counterparty, no restrictions, no interference. And the buying hasn't stopped even now, despite everything happening. Central banks are still expected to buy around 850 tons of gold in 2026. That's nearly double the average before 2022. So even during this crash, the long-term demand is still strong. So why call this the biggest reset? Because multiple forces are colliding at the same time. Let's break it down. Force number one, forced selling countries like Turkey and Russia are being pushed to sell, not by choice, but by necessity. Force number two, temporary demand pause. China paused buying. India slowed down, but they didn't exit. They're waiting. Force number three, structural demand is still there. The reasons for buying gold haven't changed. If anything, they've become stronger. When these forces align, you get something rare. A moment where price drops, fear rises, weak hands exit, but the core demand stays alive, and that creates a setup for a much bigger move. The illusion of weakness. Right now, gold looks weak. The chart looks ugly. The sentiment feels negative. But here's the twist. Weakness caused by forced selling is not real weakness. It's temporary. Think like institutions. Big players don't panic like retail investors. They don't just look at price. They look at why the price is moving. And right now, they see something very different. They see a temporary imbalance, a forced liquidation, a future supply constraint, the Russia factor, critical detail. Now, here's something most people completely missed. Russia is about to do something big. Starting April 2026, Russia is banning gold exports above 100 grams. That means no more large-scale exports, less gold entering global markets, reduced future supply, the short-term pressure. But before that happens, there's a window, a short one, where Russian holders can still sell. And guess what? They are selling right now, fast. That adds even more pressure to the market. But here's the key. This pressure is temporary. Once the deadline passes, that supply disappears, supply down, demand returns. Now think about what happens next. Forced selling ends, export supply drops, central banks return. What do you get? A tightening market. And when supply tightens in a high demand environment, prices don't stay low for long. The big targets. Some major institutions are already looking ahead. They're not focused on the drop, they're focused on what comes after. One major projection suggests $6,300 gold by the end of 2026, and in a stronger scenario, $8,000 gold. Now here's the crazy part. Those targets were made before this recent sell-off, and they haven't been canceled. What does that tell you? It tells you something very important. The smart money doesn't see this as the end. They see it as a setup, the real opportunity. This is where most investors get it wrong. They focus on price drops, fear short-term losses. But the real opportunity that comes from understanding the cycle, because resets don't destroy bull markets, they fuel them. The question you should ask yourself, are you reacting to the drop or preparing for what comes after it? What happens next? That's where real money is made. Right now, most investors are confused. Some are scared, some are selling, some are waiting, but very few actually understand the roadmap ahead. And that's exactly what I'm going to give you right now. A simple, clear, three-phase playbook that explains what's happening and what's coming next. Phase one, the forced liquidation phase, we are here. This is the phase we are in right now, and it's messy. Gold dropped from $5,596 around $4,400. That's a 21% scoot drop in a very short time. And the reason is simple: forced selling. Let's recap what's driving it. Turkey selling gold to defend its currency. Russia selling to fund war investors reacting to fear short-term dollar demand surging. But here's the key idea. These sellers are not choosing to sell. They are being forced to sell. And that creates something very important, a finite supply of selling. Why this phase always ends. Think about it like this. A country can only sell the gold it has. It cannot sell forever. So eventually, the selling slows, the pressure fades, the market stabilizes. Right now, analysts estimate that Turkey alone may still have around $30 billion worth of gold that could be used, but that's not infinite. That's a ceiling, the mistake most investors make. During this phase, people panic. They see prices falling and assume it's over, so they sell right near the bottom. But history shows something very different. This phase is where the best opportunities are created. Phase two, stabilization, the turning point. This is the phase that most people miss because it doesn't look exciting. It doesn't feel dramatic, but it's where everything changes. What needs to happen first? Two key things. One, currency stabilization. Right now, Turkey's currency is under massive pressure, but eventually the scoot slows, the currency stabilizes, the need to sell gold decreases. When that happens, one of the biggest sources of selling disappears. Two, oil prices calm down. Remember what triggered this entire chain reaction? The oil spike. If oil falls back into the range of $85, $95 per barrel, then dollar demand drops, pressure on importing countries decreases, forced selling slows what this phase looks like. During stabilization, prices stop falling, volatility decreases. Sentiment is still negative. This is the boring phase, and that's exactly why most people ignore it. But smart investors, they watch it closely because it signals something powerful. The reset is ending. Phase three, structural re-entry, the big move. This is where everything changes. Once the pressure is gone, the real buyers come back. Who are these buyers? Central banks, long-term investors, institutional players. And remember, they never stopped believing in gold. They just paused or were forced out temporarily. Why? They come back stronger. Because the reasons for buying gold are still there. Global debt is still massive, geopolitical risk is still rising, currency trust is still fragile, and now the price is lower. That creates a powerful combination. Strong demand plus lower prices, a big upside, the supply shock. Nobody is watching. Now add one more critical piece, Russia's export ban. Once that kicks in, a major gold producer is cut off from global markets, supply tightens, availability drops. So now you have less selling, less supply, returning demand. That's not a weak market, that's an explosive setup, the end game scenario. This is why some projections are calling for $6,300 gold, even $8,000 in a strong scenario. And again, these forecasts were made before the drop, and they still stand. What you should watch closely. If you want to understand when the shift is happening, watch these two signals. One, the Turkish lira, when it stops falling, that means less forced selling. And two, oil prices, Brent crude. When oil drops below $100 and stabilizes near $85, $90, that means the pressure is easing. When both happen together, phase two has begun. The biggest insight of all. Let's bring everything together. This drop is not random. This is not weakness. This is not the end. This is a reset. a reset caused by war, energy shocks, currency pressure. But underneath all of it, the long-term demand for gold is still strong. Final thought, pay attention to this. Markets don't reward people who react, they reward people who understand. Right now, most people see fear, but a few see opportunity. The biggest moves in history always come after moments like this. Final CTA Chi teaser. So here's the question I want you to think about. When gold makes its next big move, will you remember this moment or will you wish you understood it sooner? If you made it this far, you now understand something most investors don't. And that alone puts you ahead of the crowd because the reset, it's not something that already happened. It's happening right now. And what comes next might be the biggest move yet.